Hey everybody, Marty Mazur, good afternoon, November 1st, 2016. Want to interact with you for a few minutes here on the chart. I've been promising that I would show you the setup this year versus last year at this time. Last year we were heading into the first Fed rate increase in many, many years. Fed funds futures probabilities are suggesting there's over a 70% likelihood that they will raise in December. Ironically, you may not know it because it's been so quiet this time around, but the Fed is actually involved in its two-day meeting as I speak. It's not a press conference meeting, and I will be shocked, and I guarantee you the market would be shocked if they were to move tomorrow in either direction. And certainly the next move should be to the upside, but it's not going to happen tomorrow. Very good chance it happens in December, I would add, as long as there's not some big election surprise. So the screen in front of you, again, I've been focusing a lot lately on the 200-day moving average. The screen in front of you is the 2-year daily chart for the S&P 500. The blue line is the 200-day moving average. Allow me to add a little bit here, or at least a little explanation as to why I continue to show you that one. This is from, if I can pull it over, this is from a book called, ironically, Moving Average 101, or Moving Averages 101. The 200-day simple moving average. Bulls like to buy dips when markets are trading above the 200-day moving average, while bears sell rallies short below it. Bears usually win below this line as the 200 days becomes longer term resistance, and bulls buy pullbacks to the 200-day as long as the price stays above it. This line is one of the biggest signals in the market telling you which side to be on. Bull above, bear below. Bad things happen to stocks and markets when the line is lost or when the market trades below it. So this is a long-term or a longer-term indicator, and of course we are here long-term investors. So again, the blue line, and again, I know I've shown you this a lot lately, when it turns and begins to slope lower, it tends to be times that you need to take volatility seriously, if you will. And as the book I just referenced says, things tend to happen below it, or bad things tend to happen. So, but you can see there are times when we peak below it, but then continue to find it as support. If you follow back to the correction we had toward the end of last year, or in the fall of last year, we pierced below it and then came back, found it as support for a while, and then after that Fed rate hike, couldn't hold it, came back, tested it once on Brexit, and here we sit today. Allow me to just give you a little more texture, if you will, and I'm gonna layer on the 100-day moving average, which is a little bit faster signal. Still should be considered long, or at least intermediate term in terms of its indication, but the relationships between the two, lots of technical traders pay attention to these, and that is when the faster or the shorter term moving average moves above or below the longer term one, that becomes a bullish or a bearish signal. Notice that, and I just put the circle here because this is roughly where we were last year. Essentially right here is where we are today versus this time last year. Notice the blue line, the 200-day moving average had actually come above, or I should say the 100-day had actually crossed below the 200-day, and that would be a very bearish sign. So we had that rate increase right in here, and then we can see what happened thereafter. So the question is, in terms of the longer term trend, what would be the setup today? So again, notice the longer term moving average on top of the shorter term, and let me just move the circle over to where we sit right now. Of course, that's the end of this chart. And look at the difference. The green line, the 100-day moving average, is substantially above the 200, plus the market is trading above the 200 average as opposed to where it was kind of vacillating over here. Does this mean that there's any guarantee that the market will not give up the ghost and trade lower from here? Absolutely, positively no. This just basically talks about probabilities and the setup this year versus this time last year, which is a much better looking setup to me. Let me run this back. In fact, I'm just going to jump way back 15 or 16 years or so, I guess 16 years, and just show you the relationship between these two moving averages. Notice that when the blue crosses above the green, bad things tend to happen, and also, of course, when the blue is sloping down. Notice here in the year right after the tech bubble burst, when the green overtook the blue again, and the blue turned up, again, the 100-day versus the 200-day, things began to get better. You can see there were some tests along the way, like we've had lately, but all of this was volatility to ignore until we came up. The green, or the 100-day, fell below the 200, and the 200-day turned over, and there would be the mortgage crisis. So if you saw that coming in here, you would have had a good warning that really bad things were to come. So then we come up through here. You can see we had some tests for long-term investors. That was a pretty good correction in 2011, and sure enough, we got that signal kind of halfway through it that would be volatility to pay attention to if we were worried about being in the market during big drawdowns, if you will. And then all the way up from then, although we've been we've had a very, very flat period since here the last couple of years. But as long as the green was above the blue, you didn't get too nervous. But as you can see, it came down below and the blue turned over, and we had those two corrections. This was the worst start to any year in history, essentially the first few weeks of January. But once again, here we are today, a much better look in terms of the moving averages and the setup. Now let me close just by giving you a very short-term look. I've been talking lately about 2120 and 2100 as levels on the S&P to pay attention to. Last week I showed you where we came right down on 2120 and bounced right off of that. Well, we pierced through that today. So here you can see that 2120 holding a support, and here is the last week or last few days where I showed you we bounced right off of that, and here's where it happened just this last week. Well, we finally broke down below that. And remember I said 2100 looks like it could be a line in the sand to me, although anything can happen. Again, election surprise or what have you. Some would suggest that a surprise in the Washington Post poll today was something that the market got very concerned about. We also have, of course, the prospects for a Fed raising interest rates in December. One could speculate what this is all about, but we had a down day today on pretty good volume. And when we got down below that 2100, it did not stay there for any time at all and came bouncing right back. So the 2100 held, the 2120 did not. The fact that we came back and we're above 2110, technicians would tell you is a decent sign for the next few days. But I can tell you today's price action and they look at implied volatility trading and options, and that's reflected in the VIX index, that really spiked up today and it was above 20 at one point, which tells me that the quote smart money or sophisticated money is playing defense right now and buying or heavily buying put options that would protect them against a fall in the market. Does not mean they're right. It means there's a tremendous amount of short interest right now. So if things go as the market would like in the near term, you're going to see a lot of covering, and we could see a huge bounce off of that, or we could get a surprise and we can test some lower levels. In the longer term scheme of things, all of it is okay. I'm just here to help you put the short term into some logical perspective, but fasten your seatbelts if there any of you are short-term traders, because I think it's going to be very choppy. And that's an easy prediction to make, obviously, going forward, at least for the next few weeks. Thank you, as always, for watching and listening, and I'll talk to you again very soon. Take care.